Hello, everyone. Thank you so much for joining us this evening. With me today, I am very lucky to have Brian Gilday from Hamilton Lane. If you haven't met me before, my name is Kimi Rasmussen, and I have the pleasure of running our reserve segment. So if we haven't met, hopefully I'll see you in the near future. But let's kick it off. So first things first, a couple of disclaimers because this is obviously a webinar where we'll be talking and deep diving into a couple of our new portfolios. So it's just important for everyone to understand that this information is intended as educational and for informational purposes only. It's not intended as specific advice or recommendations for any individual. So you should reach out to your wealth advisor or your other financial advisors, tax advisors, etc., to discuss your individual situations. The other thing is that this is obviously a webinar about private infrastructure and private equity, which are only available to accredited investors here in Singapore and professional investors in Hong Kong. So the content that we'll be sharing today and the stuff that Brian will be deep diving into is intended only for accredited and professional investors. We've tried to ensure that we only have accredited and professional investors on the webinar, but if for some reason you are on this webinar and you are not, then please be aware that this may not be for you. But speak to us and we can verify you. Okay, so if you are relatively new to StashAway, just wanted to quickly share our full suite of product and services. I'm not going to go into details, but as you may or may not be aware, we have our cash management offering. We have our core portfolios, which is our general investing portfolios, flexible portfolio. Then we have various thematic portfolios, and then we have our alternatives, which again is only available for accredited and professional investors. So in Singapore, we have had our private equity and venture capital portfolio for quite some time. This is purely closed-ended funds. Then we have angel investing, crypto. And then, of course, we have just launched our semi-liquid private equity portfolio in partnership with Hamilton Lane, which we'll be talking about today. And we have private infrastructure as well, which we will also be talking about today, and then private credit, which we've had for a little over a year now as well. And these three, so all of the semi-liquid portfolios, private market portfolios, are available in both Hong Kong and in Singapore. So these are the two we're going to be talking about today, private equity and private infrastructure. And why allocate to private markets? I think it's quite important to mention why StashAway decided, granted quite some time ago, to introduce private markets. We think it's super important for investors who have access to private markets to add this to their portfolio to broaden the diversification. I'm sure Brian will go through returns, etc., especially in 2022, but where bonds and public markets or public equities plummeted quite a bit, private markets actually delivered very good returns. So this is a really, really strong way to further diversify your portfolio. It helps enhance returns and lower the volatility overall. And as you may already be aware, or if you aren't, you are now, we do offer these semi-liquid options. It's a monthly subscription and a monthly redemption, which is what is great about these funds. There is a 12-month login. The minimum is only USD 20,000, and any top-ups will be a minimum of USD 5,000. Speak to your wealth advisors. They can take you through more. In Singapore, you have Janelle, Vincent, and myself, and in Hong Kong, you have Pacey. If you scan the QR code, you can leave your details, and then we will reach out to you as well. Otherwise, take a quick picture of this slide. Okay, Brian, I'm going to hand over to you. So introducing Brian Gilday is the Managing Director and Head of Evergreen Portfolio Management at Hamilton Lane, and it's really awesome to have you here. So thank you for taking the time.
Thank you so much. It's great to be here, and thank you to everyone in the audience joining us today. I look forward to talking a bit about Hamilton Lane and then the Global Private Assets Funds and the Global Private Infrastructure Fund. Okay, so just first 1 minute on Hamilton Lane. So we are a global private market investment firm. All we do is private markets. It's all we have done for 34 years at this point in time. And we're very large at what we do. So we are a global firm. We have 22 offices around the world, including the locations that you are joining us from today in your markets. I'm based here in our global headquarters, which is in Philadelphia in the United States. And as I said, all we do is private markets, and it's all we've done for 34 years. So we have over $900 billion of assets in the private markets. And the tenure in which we've spent in the private markets and the amount of data and the analytics we have around it has really helped us provide access and information and understanding of everything that's happening in the private markets. And that's what we've done for large, originally institutional clients for many years, and increasingly now through products like these evergreen products into the private wealth market. So we are thrilled to be partnered with StashAway here as your private infrastructure and private equity partner in the funds that we'll be talking about today. So I'm going to go through some of these slides fairly quickly, but did want to give you a snapshot of our business in the evergreen or semi-liquid space. Currently, we believe we are one of the larger managers globally operating in this space with $11 billion of assets across different private market strategies. So that includes equity, credit, infrastructure, and increasingly more and more customized offerings in this space. And importantly, we now have a 6-year track record of running funds in these kinds of structures. So we believe we have one of the most long-standing track records of delivering great private markets offerings in these evergreen or open-ended fund structures. So let me talk about the Global Private Assets Fund. This actually was the first of these evergreen structured funds that we launched, and we're going back about 6 years now. And so I'm going to talk a couple of reasons about why having private equity is important for investors, what it delivers, and what you can expect out of it. That is the core of the Global Private Assets Fund, is private equity. One of the first reasons that investors like having private equity in the portfolio is for performance. So what we are showing you here is the performance in the light blue bar of private equity, the all equity market, compared to the public equity market. And what you've seen is that over long periods of time, private equity has outperformed the public equity markets. That is the reason that historically institutions have had large allocations into private equity, and increasingly private wealth investors are looking to add allocations as well. It's for that performance and the diversification. So when you're investing in private equity, you're buying the equity of companies that are not publicly listed. You can't access those in the public market. So if you think about all of those market leading businesses that some of you may have owned yourself, or you may be owners in, or you're aware of, that aren't publicly listed, that would be the private equity market. I think this is an important slide, and one that often surprises people. What we are showing you here is the percentage of companies globally with revenues over $100 million that are public versus private. And you see that only a small number of those companies are actually publicly traded today. So the vast majority of businesses globally with revenues over $100 million are private. It's something like 85 or 90% of those businesses. So if you're only investing in the public equity markets, you're missing out on that huge universe of businesses that are really a big part of the global economy. One of the other themes we talk about in private equity is the fact that value creation has shifted away in some cases from the public markets and into the private markets. And we're showing you a couple different metrics to do that. So first of all, the number of listed companies in the United States, using as a proxy for other markets, has been cut in half over the past 20 years. There are fewer public companies than there used to be. Those companies are going public later, and they're larger than they ever were before. So if you look at the average size of companies by the time they go public, they're much larger. And many of these great new leading businesses of the next generation are generating more of their return for private shareholders, for venture capital funds or private equity firms, and less of those returns are happening in the public markets as companies stay private for longer. So again, pointing to the need to access the private equity markets and the private markets to get exposure to those next generation of technology leaders and global leaders. I think there are also some misperceptions about how private equity works and how you expect it to perform in different environments. So I really do like this chart. What we are showing you here across the industry data, this is not our performance, this is industry data, is that the best 5-year performance in the private equity market over a 5-year period was a 27.5% return compared to the public markets. The best 5-year stretch was a 19% return. So in very good markets, the private equity market has outperformed the public equity market. And if you look for the worst 5-year stretch of performance in those asset class, you'll see the public markets were down over a 5-year stretch ending in 2022. Whereas the private markets, the private equity market, the worst 5-year stretch was still positive performance. So good upside capture in good environments, better downside protection than the public markets in more challenging environments. And I know we'll circle back to 2022 in a minute as well. This is also some great industry data on what to expect in different public market return environments. And I think this is also an important chart. What we're showing you here is in different public market return environments. So this is a higher returning public markets where the public markets have generated over a 15% return for 4 years. We're measuring here the private equity outperformance. So this 270 basis points means that in those good public markets, private equity has still beaten them, but by a smaller margin, about 270 basis points. In more challenging public market environments, like up 5 to 10 or roughly flat, you see that private equity outperformance is greatest. So if you believe that public equities might be a little bit more challenging going forward, then that private equity outperformance piece would really show up in a bigger way. This is, again, industry data going back now 30 years. So I'm not going to spend any time on that chart. I want to talk specifically about the Global Private Assets Fund and these open-ended evergreen structures. The Global Private Assets Fund is largely a private equity fund. It does have a little bit of private credit in the fund as well. It is an open-ended fund with limited monthly liquidity. And so what that means is investors can subscribe into the fund on any given month, and they're also able to redeem out of the fund monthly at fair value, but those redemptions are limited to 5% net of the fund per quarter. So if all investors wanted to be out, they would have to be pro rata cut back to that 5% of the fund's overall liquidity. Now, I should note that any investor that has ever requested liquidity out of this fund historically over 6 years has gotten full liquidity out of the fund. But investors need to count on the fact that if investors globally were asking for their money back, the fund could be limited in terms of that redemption piece. The net returns for the fund have been 10 to 12% targeted over long periods of time. The fund has been, and I'll show you the data, less volatile than the public markets. And today, the fund is approaching about $6 billion US dollars. Now, one of the real benefits for investors of these open-ended structures is once you make a commitment into the fund, you are fully deployed, invested in the fund with no ongoing capital calls. So you don't have to worry about capital calls being drawn down over time like you do with closed-end funds. And that has made these funds much easier to use for most individual investors. This is just a snapshot again of comparing our Global Private Assets Evergreen Fund to a traditional drawdown private equity fund. And it's not that one is better or worse, it is that they are different, right? So these open-ended funds allow you to be fully deployed, lower investment minimums, monthly limited liquidity, and diversified through a single allocation, making it easier to access than traditional drawdown private equity funds with 10 to 12-year lockups and larger ongoing commitments. So that is a big part of the reason these funds have been broadly accepted by the market fairly quickly. In terms of what the fund invests in, it's really two of these three buckets. It's direct equity, which is private equity investments in individual companies in the private markets. So there is a manager that goes out, finds a company, cuts a deal with the owner to buy the business or a stake in the business, and then governs that company. We come in alongside of that manager that is governing the company. We have hundreds of relationships globally with specialist managers in their areas of expertise. That's really the benefit of our platform as a firm and what we've done for 30 plus years. And so we pick individual companies to invest in that are generally market leading businesses with a strong investment thesis and we own those positions for 4 to 6 years in the fund. We also invest in secondaries, and you may be familiar with the secondary strategy in private equity. And that just means simply buying into individual assets or pools of assets that have been owned for some period of time already. So there's an existing investor in the asset or in the fund that is looking for liquidity before that full 4 to 6 year investment cycle has really played out. And because of our data advantages and our relationship advantages, we can identify really interesting positions to buy into those assets later in their life, which means we're going to own them for less time than a new 4 to 6 year investment. We may own them for 2 to 3 years before we get liquidity and return back. We also do have a small amount of private credit in the fund. It's just under 10% of the fund today, which are loans to these same types of businesses, although not specifically to the exact same companies here, which help provide yield and stability to the fund. This is what the fund looks like. So here's a snapshot of the existing assets within the fund. The fund is over 150 different underlying investment positions, and it is made up largely of co-investments, those direct equity investments I described at about 50%, the other roughly 50% being secondaries. We like that blend of those two strategies. We do have some private credit, as I mentioned, individual loans to companies. These are not funds. There are no underlying funds that we are investing in out of this. It is all transactions into new companies or secondaries. And we do pick up a little bit of venture and growth in the portfolio. That tends to be a higher risk, higher return, longer duration part of the portfolio. So it's a smaller part, but we do get some exposure into some of those next generation leading businesses. From a geographic standpoint, our mix looks fairly like the industry, which is that North America is the largest, deepest part of the private equity markets, but we do get some nice Western Europe exposure, a little bit of Asia Pacific and rest of world. And we want to be diversified by vintage year, which is the underlying year that that company was acquired, because those companies tend to be owned for 4 to 6 years. In the case of venture, longer than that even. And then diversified by industry and by the different managers that we have done transactions with. So we think that's a tremendous advantage of our firm and our platform is the breadth of specialist manager relationships we have, providing us access on a fee-free basis to these individual companies that we can invest in. And so this fund ends up being a very cost-effective way for investors like yourselves to access the private equity markets through the relationships that we have as a firm. Here is the performance and volatility. I think this may be the most important chart in the deck. I told you that over time, we launched this strategy expecting to generate 10 to 12% net returns with a lot less volatility than the public markets and a lot more consistently. And to date, over those 6 years, we've generated slightly better than that, 12%, 12.8% net returns. On an annual basis, you'll see that in some very strong equity environments, 2021, the public markets did very well. We also did well. 2022, when the public markets struggled and were down double digits, we actually generated an 8% return. So again, the resilience of the private equity market compared to the publics. I'd say last year actually was our weakest year from a calendar perspective at just under 5%, but you have seen performance accelerate in the early part of 2025. So the public markets really did well the back half of 2024. That did take a little while to flow through our portfolio in terms of underlying earnings growth and strength and momentum. And you've seen that come through early this year. So up 5% through May of this period. Overall, the volatility of the fund at 5% since inception is about a third or a quarter of the volatility of the public markets over that period of time in a diversified portfolio. So if we look at the monthly returns, the public markets are light blue, our portfolio is dark blue. You see a lot more consistent up months from our fund. Some down months, but they tend to be fairly small compared to what happens in the public markets. Even when the pandemic hit, for example, you'll see that our down marks were much, much smaller than what the public market experienced overall. So for us in 2025, we, of course, are paying attention to what is going on globally with tariffs and trade. We believe the portfolio is very well insulated from those trends. Our fund is focused on small to mid-sized businesses, largely in the services space. So we don't pick up a lot of those businesses that have the greatest challenge from trade. from trade struggles that the U.S. administration is creating currently. And in the past, uncertain macro environments have created some really interesting investment opportunities for us and for the fund. So we're excited about the environment that we find ourselves in currently. The last point I'll just say is I talked earlier about the fact that we offer up to 5% net out of the fund back to investors every quarter, should investors look to redeem their fund investment. The way that we do that is by building an underlying portfolio that generates about 25% liquidity on average. So we expect that the portfolio each year through underlying investment realizations generates 25% liquidity. What we have done in almost all cases historically is we've reinvested that liquidity back into new investments. So we've never actually had a quarter with negative flows out of the fund. So all of the liquidity to date, any investor that's wanted it has received their liquidity back. Otherwise, it's been reinvested into new investments. But that portfolio construction is what enables us to build a fund where we know we can offer net to investors 5% per quarter out if they would like liquidity out of the fund. If I move over now, and I know we'll take questions at the end across both strategies, I want to move over to talk about our Global Private Infrastructure Fund, which follows a lot of the same construction and thought processes and advantages we have, but targets a different market, which is the private infrastructure market. So you're all likely familiar with infrastructure. There are different forms of infrastructure, some of which we would say is economic. So the user is paying for services provided. That might be for pipelines, it might be for wireless infrastructure, it might be for toll roads or rail transport. And then there's also social infrastructure where governments are building services to provide to their constituents. And often those are public investors that are providing those services. There's less private capital into those parts of the market. So here you see an example of a public university. So why do investors invest into private infrastructure? Well, they do it for return, particularly risk-adjusted return, and for less volatility and low correlation. So in general, many investors, as they think about that overall portfolio construction, want to make themselves less correlated to the public markets moving, and they want some consistency and stability and inflation protection. So all of those are characteristics that are demonstrated in infrastructure assets, including also yield. So in general, infrastructure assets have some kind of current cash yield that is coming off of the portfolio. So over long periods of time, these characteristics have proven very resilient within the infrastructure market. And so investors are adding that in to complement their existing equity and credit exposure. Here's some specific data around what adding infrastructure into a traditional 60-40 portfolio does. So if you were to add a 10% private infrastructure allocation into a 60-40 portfolio, you would historically have improved your returns and reduced your risk, reduced your volatility. So it is additive to a portfolio overall for investors. It also has a very low correlation to public equities and a strong history of capital preservation. So again, you'd say infrastructure shines in environments where public equities may be a bit more challenged. 2022, again, would have been a great example of that, where public equities and public credit traded off. Infrastructure performed nicely in that kind of period with strong performance and a lot less volatility. Investors also do believe that if you worry about inflation, that infrastructure historically has been a very good protector against inflation because asset values in infrastructure tend to rise. So our fund today, our infrastructure fund is only about a year old. So we've been running the underlying strategies for 20 plus years in closed-end fund structures. But we launched last year our evergreen infrastructure fund, and today we have about $400 million of assets. So it's grown very nicely. We similarly invest into direct investments and secondaries, as I described in the Global Private Assets Fund. And we follow the same ideas of diversified exposure, focused on the middle market, fee efficiency. Those are really keys to our evergreen funds in general. Our targeted returns for this strategy are 10 to 12% net. I know that's the same return as our equity fund. I would say in different environments, they're likely to be slightly different, but over the long term, we think they have a similar return profile. And this fund, though, unlike the Global Private Assets Fund, does have a targeted annual distribution of 2 to 5% early in the fund's life, like we are now. Will be towards the lower end of that spectrum over time. That return will build, and it is a favorable investor structure with immediate deployment into the strategy. Here again, we're talking about direct equity infrastructure, which simply means the equity positions of these infrastructure assets. Same thing with the secondaries, is buying pools of assets that are a bit more mature alongside private managers that own those existing assets. So we're doing the same theme. Here, I would say the important part is that we are focusing on the core plus and value add segments of the infrastructure market. So there do tend to, in infrastructure, be some lower returning assets that are things like airports or toll roads often that would be lower returning, that would be considered core assets. We're focusing a bit more on places where there's a slightly higher performance because those assets are a little less steady, stable, and there's more some value add element where the manager is doing something to expand the business, to make it better, to help drive those higher returns to get to the 10 to 12% place overall. And here's an example of the four themes that we're investing in today. If you think about what's going on in the world economy, these themes are all very much tied to growth. So energy transition, huge theme, huge need for capital spending. Infrastructure is the place where you invest in renewable power or energy transmission or decarbonization. Supply chain and logistics, right? Goods move all around the world. With or without tariffs, they'll continue to move all around the world. And that is a big theme where there's a huge need for investment. Digitization, of course, right? Data centers, cellular towers, broadband, everything that's supporting artificial intelligence and energy needs is really a big part of these themes. And then, of course, environmental, whether that's waste management, resource efficiency, circular economy. That is the fourth big theme that we are playing on investing out of this fund. And here's what the fund looks like today, including performance. So performance has been very, very strong. I explained that over the long term, we expect 10 to 12% net. We have significantly outperformed that early in the fund's life. I would say that the 10 to 12 long term is what we expect out of the fund. But we've done a really nice job here to date with some very strong assets that have performed. The fund is nicely diversified already. So even though we're only just over a year in, we've got good diversified exposure. We've made 31 different investments. It is hitting on exactly the themes we expect to hit on. It is nicely diversified by all of the metrics that we think about. And I think at that point, I'm going to stop and take questions.
As you can tell, we're saving a lot of time for questions because we want everyone to walk away having all their questions answered by Brian, since we're so lucky to have him on this webinar. But whilst we wait for that, Brian, maybe we could double click a little bit on the GP relationship. So when we talk about multi-manager exposure, what are we actually talking about here? Because I think this is a very, very interesting fact about or feature of your funds and why this is quite unique to your funds.
It is. We would agree. So I mentioned we've been around for nearly 35 years, and we think our biggest value add to our clients in our industry, which includes very large, sophisticated institutions and private individuals, is the fact that we have built out a network of 300 plus managers who we have invested in their funds with. We don't do that out of this part of the business, but in other parts of our business, we invest with these managers in their funds. And that's actually the largest part of our business historically. So we're very good at knowing who the best private equity, private infrastructure, private credit managers are in the world. We're really important clients of theirs because we commit a large amount of money into their funds. And what that means is that they are eager to have us as investment partners when they have transactions that they're trying to complete. And so they come to us and say, I'm going to buy this data center. I need additional capital. Hamilton Lane, would you like to invest in it with us? And for our investors, what we think that big benefit means is that you're not relying on any one manager or any one manager's style of investing. So we think the key to building a high-performing portfolio is being diversified across sectors, geographies, and investment styles in the private market. So unlike the public markets where I guess you're picking a company, but you're not influencing that company. In the private equity markets, these managers are governing the companies day to day, and
Yeah.
they have a skill set that they're good at, and a style that they're good at, and a sector that they're good at. So we think that that multi-manager approach means you get all different manager skill sets, all different styles, all different geographies, and we can find the best of the best globally at what they do. And so that, as you think about your one investment into private equity or your one investment into infrastructure, having that multi-manager approach de-risks the investment and brings that best-in-class approach.
Yeah, absolutely. And can you maybe tell us or just remind us how many different GPs do you work with on the private equity side and how many on the infra side?
Sure. Yeah. So it's I don't recall the exact number offhand.
Okay.
However, we have like 300 or 400 active private equity manager relationships today, and on the infra side, I think it's 200 plus active manager relationships today. As we think about the deal flow, I like to quote this as we look at these funds. These funds invest in something under 2% of the opportunity set that we see each year across secondaries and direct investments. So we have hundreds of investment opportunities coming through our platform each year, and we're selecting a very, very small number of the best opportunities that we think fit nicely within the fund and generate the risk and return that we're looking for. So that selectivity is a really important part of building a portfolio like this over the long term.
Yeah, and that's also why we're very excited about these funds. Okay, so we have questions from our audience. Let me just have a look. Okay, so we have a question here. Do you think, or don't you think, that the democratization of private equity will push funds which are compensated based on the size of the assets under management to invest in lower quality assets, thus reducing returns for investors? What is the reason for the performance decline in 2024 compared to previous years?
Sure, absolutely. So it's interesting that the press part of the equation plays out very much in the story of democratization and all this money flowing into the private markets. What I would say is if you look at the industry statistics, the size of the private equity markets and not private credit, private equity, private infrastructure markets are smaller today than they were 2 years ago because institutional investors have been investing less new money into the asset class because they've been getting less money back. And so while firms like ourselves, a small number of large firms have been very successful in running these open-ended evergreen funds, it's actually a very small segment of the overall private market. So today, there is less new money going into private equity and private infrastructure than there was 3 years ago. So our view is that at some point, you could make an argument if the asset class goes so great that you should expect different returns or it might be more challenging. We are nowhere near that point today. And in fact, remember that each of these investment opportunities, you have to find a company that is willing to sell. It's a private negotiation to buy a business. So it is not like the public markets where more money comes in and it crowds out a specific stock or trade. There is an infinite number, 90% of the companies globally that are private today. So there's a long way to go before worrying about that concern. The performance one in 2024 is a great question, and I should have addressed this one earlier. One of the big themes we were talking about in the private equity industry last year was the public markets were roaring, and private equity actually had a not great year. So we were about 5%. We think the private equity industry last year did about 4%. So we only slightly outperformed. We've outperformed better in our other vintage years. But part of that was the big reason the public markets were moving was just valuation multiple expansion. Earnings didn't really grow that much. The public markets got very excited in the back half of 2024, particularly after the US election, that inflation was coming down, less regulation, less taxes, all of those things, and really traded up on valuation multiples. We didn't see that in the private equity markets, but I did refer to that in early 2025, we saw those strong earnings in our portfolio companies come through. And so last year, our portfolio companies in the Global Private Assets Fund grew their earnings by about 12%. And so we weren't seeing valuation multiple expansion in the portfolio, but we were seeing underlying earnings growth. And I think that was the big disconnect relative to the publics. I would say that over short periods of time, the public markets and the private equity markets may become a bit disconnected. Our private equity assets tend to not have multiples move around as wildly as the public markets do. So we don't become as overly enthusiastic when things look great, nor do we become as worried, I guess, when things look bad in the short term. So you do see a narrower range of valuation multiples, but we think the portfolio is set up and the asset class is set up for very strong performance, given the public markets are saying the environment looks pretty good. We should be paying high valuations for companies, and the outlook is positive.
Thank you, Brian. And I guess that's also why you want to diversify. So you want to have public, you want to have private, you want to have everything to make sure your portfolio is looked after through different times.
That's true. I think our investors really appreciated it. And I mean, public investors love 2024, but they really appreciated us in 2022, right? And
Exactly.
having those things that are firing at different points in time is really helpful.
Exactly. All right. Another question for the private infrastructure fund. And I reckon we're going to get quite a few questions on this. But the first one is for the private infrastructure fund. How many assets do you plan to hold in the portfolio?
Sure. So with these evergreen funds, because they're always accepting new investor subscriptions, they tend to be fairly diversified and you tend to build assets over time. And so ultimately, I would think that it will look something very similar to the Global Private Assets Fund, which is 2 years from now, there'll be 100 plus investments. Even with 100 investments, by the way, because some of those are secondaries, you're picking up smaller positions that might be in 10 assets or 15 assets. So ultimately, there will be a big tail of smaller things that we own. But as we make new investments, we tend to think about position sizes of roughly 1 to 2% of the fund size overall. So it will always be diversified. There will always be new investments that are among the larger investments as the fund grows. But I would think of that 100 plus investments as being a fairly good number for the next couple of years.
Great. And on the outperformance, and this is why I knew we were going to see a lot of questions on infrastructure, because obviously it's been a very, very, very good year in the last year for this fund. You mentioned the fund is quite young, and we should expect that it will get closer to target in the longer term.
Yeah.
So,
Yeah.
so can you tell us a bit about what caused the fund to perform that well, and why do you think in the longer term it may not be 30% that was
Yes, yes. Data doesn't suggest that private infrastructure does 30% over long periods of time. So when we set the return targets for this fund, we use industry data and we say, what is a reasonable thing to expect out of the asset class as opposed to picking a number that investors like to hear. So we've taken that data-driven approach. And over the long term, as you heard in the Global Private Assets Fund, we've outperformed our target. We hope to and expect to be able to outperform our target here too. Given the way that we're selecting assets that we think are the best of the best. In the short term, the fund is small and a rapidly growing fund is more concentrated. And we've had a couple investments that have really performed terrifically out of the gate. So two things can happen in these funds early on. One is when we're doing secondaries, sometimes we can buy assets at discounts to fair value. And so starting with a small fund, buying some good assets that are at a discount to fair value and having them appreciate over a small period of time does drive some of that return. Also, I think the investment selection piece has worked very well. So we happen to have found some great direct investments where we saw there was very strong momentum in the underlying company. And so 6 months or 9 months into owning them, we've seen pretty meaningful markups on some of those assets. So that is hard to do consistently the way that we've done it. We are super pleased that we've outperformed our other funds. Our GPA fund also had a similar dynamic where out of the gates, we were really outperforming the long-term target. We've continued to be able to do that, but the 28% number is not something we should expect in all environments over the long term. We also had the benefit of a good environment for infrastructure here over this time frame.
Yeah, so maybe let's zoom in a bit on that, because the next question is also on the performance, but in comparison to the Global Assets Fund. So what drove the strong performance in infra versus private equity, I guess?
Sure. Yeah. So I would say to my comment about the infrastructure environment's been a very strong one over the last 12 to 18 months. Investors have been worried about inflation. Those businesses have been able to pass on price increases, and the underlying growth has been very, very strong in that infrastructure space. The private equity space, if you read about private equity in 2024, you wouldn't hear those things. You would hear that it hasn't been a great environment for private equity. The reason for that is there have been fewer exits of assets in private equity. So if you go back to early 2024, late 2023, the public markets had traded off. There was a lot of uncertainty about inflation and interest rates, and private equity assets weren't being sold and have continued to be sold at slower rates than historical average. So one of the biggest things that drives returns in private equity and private infrastructure is selling those assets. So buying them, owning them for 4 to 6 years and selling them. And we tend to see in the data industry wide that when assets are sold, they tend to be sold at about a 20 to 25% uplift from their recent holding values. And that's really a control premium, right? The buyer is willing to pay a control premium. So with fewer exits coming out of the portfolio, performance has been more challenged despite the public markets doing well. Our view had been, and the views, if you read about M&A outlook or things like that, was that the environment would be getting better for realizations and financings and company sales, and that you would really start to see that performance show through in a bigger way. Our view, as you heard overall, is that each of these strategies over long periods of time should be a 10 to 12 net, and that we can deliver on that. But they will perform at different points in the cycle, which to your point, Kimmy, is that's the benefit of having a diversified portfolio. For us, it's not choosing one or the other. It's that they have different characteristics and are likely to have their best performance in different types of environments. So private equity will have the best performance in a good equity environment with good realizations. Infrastructure may have the best performance in a higher inflation environment or something else than that kind of equity environment.
Absolutely. Okay, the next question is technically just on the age of the infrastructure fund. So
Hmm?
we only have a track record that is fairly short, and that's because the fund is quite young. You want to touch a bit on that?
Yes, absolutely. So as a firm, we've been around 34 years. We before running these evergreen or these open-ended funds, we've run closed-end funds in these strategies. So our infrastructure track record as a firm goes back 20 plus years. I think I can say this, it's a mid-teens track record. We are limited in what we can say or show in terms of track records for these evergreen funds because they're different. Having said that, we believe that through the Global Private Assets Fund at 6 years old, we have shown that we are a good manager of open-ended private markets funds. And so therefore, the combination of a strong infrastructure track record in closed-end funds, which you can find on our firm's website, and the ability to manage evergreen funds gives us the strength and the credibility and the conviction to be able to talk about the long-term expectations for performance around the assets.
Yeah, and evergreen funds, generally speaking, is not something that's been around for decades, right? It's a reasonably new type of vehicle or structure.
Correct, you're right. So our Global Private Assets Fund at 6 years is one of the most long-standing evergreen funds. And today in the infrastructure space, I mean, I don't think there's any open-ended infrastructure space with a track record over 2 years or something like that. It is a newer structure that we think works really well if we're thoughtful about how we do it. But that is the reason that for other funds as well, you won't see very long-term track records. But again, the same types of assets, in some cases, the same exact assets are going into these fund structures as into the closed end. It's really about the ease of use for the end investor. That's the big difference in these structures. It's not the types of things that we're investing in. And so those long-term track records that we've built are very relevant to these strategies.
Yeah, absolutely. And maybe since we're on that topic, do investors give up anything by going into a semi-liquid fund or an evergreen fund versus, closed-end traditional private equity funds. So what we
Sure.
typically hear is that you would get a higher performance with closed-end funds versus a semi-liquid fund. But how do you look at that or see that?
Absolutely. Well, so I'll give you a couple answers on that. The great thing is there's now data that talks about this. And so in our firm's market overview this year in the equity strategy, we showed that industry-wide, evergreen funds had slightly outperformed closed-end private equity funds. So you're right, the perception was there that being in closed-end would generate higher performance because of a cash drag or something else, but that hasn't been the case to date. What I would say is the big difference is you're churning the cash management over from the investor, yourself, to us. We would say we're better suited to be able to manage that cash, to find new investments, to send liquidity back than the end investor. So there is some small cash drag element of us reinvesting that money, but it has been very, very small. And in fact, the data suggests that these funds have outperformed the closed-end funds. The give up is really more about customization. So if you're a big institution and you have a big portfolio and you want to do lots of niche things, you can't do that today in evergreen funds because there are not enough of them out there. So I would say it is more about that than it is performance, which is, again, why these funds have grown so dramatically and received such widespread adoption.
Thank you. Okay, so another question from our audience. For the private infrastructure fund, what percentage is in public listed equities versus private infra assets?
Sure. 0% in public listed assets. So all private, which is where the performance is, which is why there's no volatility. I would say that in our global private assets fund or private equity fund, sometimes a company will go public. So we would have owned it as a private company. It may go public. It's a small percentage of how private investments are exited. Once it goes public, we sell down the shares as rapidly as we're able to, which might be 6 months or 12 months. But in general, there is no public exposure for new investments. The infrastructure fund has none today. The global private assets fund would have less than 2% today, and those would be companies that had gone public recently where we'd be liquidating in the near term.
Got it. What are complex secondaries, referring to the GPA chart on the split of
Yes.
portfolio?
Sure. So the secondary market has been rapidly evolving and is a very dynamic place. And traditional secondaries historically would have been what is now called an LP secondary, where someone is selling an interest in an underlying manager's fund. It's a limited partner that is invested in a 12-year fund, and they're selling their interest in one or multiple funds. A complex secondary would be a case where we're negotiating directly with the manager to create a pool of assets and some structure around it. In the case of the deals we have done in this fund, what that generally has mean is some downside protection with upside sharing. And so if we have a manager that has a pool of assets that they think is worth $100 million today, we might say, okay, we're going to put 60 million in. We want to get the first 1.5 times return, and then we're going to share upside with you beyond that. So it's some element of us structuring in protections and participation in those pools of assets. We think that's a value add piece, particularly in a market where liquidity has been hard for these managers. So they are eager to ultimately realize what they think is the full value of the assets. But in the interim, if we can find ways to invest with good downside participation and good protection and participation, that is a nice thing for us to be able to do. And we've done a few of those.
Great. Okay. Will private infrastructure fund valuation be impacted if interest rates rise or stay higher for longer or go
Sure,
down?
yeah, absolutely. So, in all of these funds, every asset is valued every single month. If you're using a discounted cash flow method, which infrastructure probably uses a bit more than equity assets do, you do see changes in interest rates flow through. Now, one of the reasons investors have liked infrastructure is that pricing power and the value of those assets also tends to be pretty able to respond to different market environments. So in general, falling rates, as you know, are good for assets and cash flow, both equity and infrastructure. We are currently in a higher rate environment than people think we will be over the next few years. But to date, I would say the infrastructure assets have been less sensitive to interest rate moves than the equity assets have been, because of those pricing power dynamics.
Interesting. Okay, what's the size of the private infrastructure fund and how many investments does it hold? Is there a cap on single investment concentration?
Sure. So the fund today is just over $413 million. It has 31 underlying investments, but 98 assets because some of those are secondaries that had multiple assets in them. So there is no formal concentration limit in the fund today. As I mentioned, the largest investments that we tend to do are around 2%. If the fund is growing rapidly and we have good visibility into that, which we've had with infrastructure, we've had some investors that we know are committing amounts in coming months into the fund. We've taken position sizes that are slightly larger than that, but you haven't seen 5% positions in this fund, nor will you.
Excellent. That's excellent. Okay, next question. We have lots, which is great. Good thing we saved a bunch of time. Okay. Do Hamilton Lane Evergreen funds sell into the secondary market?
No, we have, as a firm, we have a great secondaries business and great capabilities. So we could sell into the secondary market. We have not out of any of our evergreen funds. The reason being, there is a cost of liquidity. So part of the reason the secondary market is attractive is that if you are a seller of something into the secondary market, you are going to take a discount. We haven't needed the liquidity. We don't plan on needing that much liquidity that we would need to go into the secondary market to achieve it. But it is a tool that we have available. The place we would most likely do that would be our private credit exposure within GPA. That tends to trade at around par in almost all environments. So that would be the most liquid, easiest place to go into the secondary market, but there are no plans to do that.
And I guess, yeah, the discount is also the benefit of, I'm guessing having part of GPA in secondaries, right? And how you also can consistently generate a good return.
Yes, absolutely. The secondary strategy exists because investors that want to sell assets today before they're mature need to take a haircut to get that immediate liquidity. And we can take advantage of that by buying assets that we like at values that we really like.
Yeah. And who do you normally see needing to sell in a secondary market? So,
Sure.
for example, my view is that you would have LPs when private equity, when public equities didn't do very well in 2022, their private market or their private equity portion or allocation of their portfolio grew to a much larger size than what it was supposed to. So rebalancing was part of potentially that sell-off in a secondary market. But are there other reasons for?
Sure. Yes, there are. So rebalancing is a big one. When the public equity markets sell off, as you noted, the denominator effect, right? So if you're an institution, you have a 20% allocation to private equity, and all of a sudden it's 25%, you need to rebalance. Here in the US, you probably read stories about Harvard and Yale needing to fund cash for their business. So they are active selling into the secondary market today. And also, you generally just have institutions rebalancing all the time. So a new CIO comes into the plan and sets up a different target allocation. And so as the asset class has matured, only about 2 to 3% of the asset class turns over through secondary. So it's still a fairly small segment of the market, but it is a very regular segment of the market for just kind of normal rebalancing activities as well these days.
Okay, so is GPI invested purely in equity or also debt? If so, what is the mix in the portfolio?
It is purely in infrastructure equity, not in debt. So we're the equity owners of these assets.
Perfect. And how do you offer semi-liquidity in the private infrastructure fund if all the investments are in, private and presumably long duration?
Sure. Yeah. So I think the interesting thing about infrastructure is while the funds are long duration, the assets actually aren't. I'm just trying to look through my screen here for a data slide. The assets aren't actually that much longer duration than private equity. So most of the infrastructure investments that we own, because they're in the core plus or the value add segment, tend to be owned for 4 to 7 years. Part of the way that we provide liquidity, though, is also through those secondaries. So if you remember that we're buying into these assets later in their life or a couple years into the value creation, in our secondaries, we tend to get about 30 cents of every dollar back each year, which means we only have about a 3-year duration in those secondary areas of infrastructure. And of course, infrastructure also does have some yield that is usually coming off of the assets. So that combination of laddering our investments in over time, including secondaries and yield, means that we're able to generate regular liquidity of 20+% a year out of the underlying portfolio.
Okay, how does GPI compare with other evergreen infrastructure funds in the market?
So there is a very, very short list today. It might be one or two. We would say from a performance perspective, obviously, we think we look really good. I probably don't imagine there's anyone that has performed this well. Again, the big difference is really the multi-manager approach that we take. So today, I think there's one of the mega managers has an infrastructure fund. So they do very large assets. They're a single manager. They have a single strategy that they invest in. We are middle market focused, diversified multi-manager. And so setting performance aside, we think we are accessing a different part of the infrastructure market and one that historically has been higher returning. That middle market has been a better returning place in the infrastructure market compared to the large end of the market. But you will over time see other infrastructure funds come out in these structures too. This evergreen structure, 2 or 3 years from now, you will see a lot more managers attempting to raise funds in these strategies, but we don't think they'll have the track record or the capabilities that we've shown here.
Okay, a couple of final questions because we are running out of time. How would you assess risk within private market investments? And would you agree that volatility is not a good indicator due to fund illiquidity?
Yeah, so the volatility one, you could have our research team come on and debate for hours the volatility measures in private equity and agree that they're not fair compared to the public markets. So looking at it, that academically leads you to say that that's not a great measure. What do we know about private equity? It has outperformed public equity over long periods of time in almost any environment. So the performance has been better. The volatility is lower just in the way it's measured, maybe part of it. But for our investors, that is a good experience if you think about your portfolio, right? The assets are valued every single month. So we may not see the high highs that the public market sentiment sees or the low lows in our asset class because we tend to take a longer term view. But that looks and feels good to investors. And remember that we don't have to sell these assets in the worst month of the year. So when the pandemic hits, the reality is our private equity managers are not planning on selling those companies at the worst period in time for monetizations. They have the luxury of knowing they can own them. So to us, the ultimate risk in private equity, we think is the beta is about a 1, which is the same as the public equity markets, but the experience is a lot less volatile because of the way the asset class is marked and because of the long-term approach it takes. And in different environments, we know that outperformance can be greater. So in a more challenging public equity environment, that value add really shows through in a bigger way.
Okay, last couple of questions. So what is the expected frequency of distribution for GPI? Quarterly, annually?
It's quarterly.
Quarterly.
It's a quarterly distribution. That's right.
Okay. Okay, and then final question. USD is currently quite weak. Do you use any currency hedge within the fund for investments in other regions for both of the funds?
We have the ability to. We very rarely do any currency hedging of the underlying investments. Most of them are North America denominated, but we really don't hedge at the underlying investment level.
Thank you so much, Brian. I know there were a few more questions in the chat, but it's more, I believe, about minimums, etc., for these funds with StashAway. So we will answer those separately and let you go, Brian. Thank you so much for joining us. And just to let everyone know that we will actually be having a few more webinars with Hamilton Lane in the coming months. So look out for the invite. We will have a more educational webinar on these two asset classes. and then another one where we go deep into these funds again. So thank you so much, Brian. Really, really
Thank,
appreciate it.
thank you. Thank you all in the audience. Have a wonderful evening.
Thank you, everyone.